Yes, obviously the macro headwinds are quite substantial out there, and yet BlueScope still able to defy all that and deliver these record profits. Tell us how.
Yeah, look, I mean, a really strong result for BlueScope, the best result that we've had in our 20 years as a listed company. What we've seen across our footprint has been really quite strong demand. We saw the run-up in steel prices, particularly in the US in the last 12 months. The cost position that we have our business in, we're very focused on making sure we keep our costs low, has put us in a position where we've been able to take advantage of those macro tailwinds, and that's really what's driven this record result for the full year.
And having said that, though, I mean, we talk about the headwinds. Obviously, there's been supply chain issues through the impact of COVID-19, rising labor, input costs as well. I wonder, what does the outlook mean for you then? Is it still as optimistic? Can you continue on with these sort of record gains here? Or, is this as good as it gets for BlueScope?
Well, I think certainly we're forecasting the outlook for the first half of the second year to be not at the levels we're at, and that's largely driven by pricing. So what we saw over the last 12 months with hot rolled coil prices almost reaching $2,000 a tonne was an extraordinary level of pricing. That's a level of pricing that we've never seen in the history of the industry. So we weren't expecting or requiring it to stay at that level. We were certainly in a position to take advantage of that. Pricing's now back around $800 a tonne. That's still a very healthy price in terms of the long run average, which is more like $600 a tonne. So we've guided to an $800 to $900 million EBIT for the first half of the new financial year, which in historical terms, if you weren't looking at it immediately after the record result we've just posted, is still a very healthy result for BlueScope.
Mm. And Mark, your guidance as far as cash flow is concerned, given the capex that you have announced in your press release here, tell us a little bit more about the seeds you're planting for the future.
Yeah, it's a very good question. I mean, we think about certainly the cash we generated this year, $1.7 billion on the back of those very high prices, as I mentioned earlier. We think carefully about how we allocate our capital, our cash. So we have a range of capital projects that we're focused on, the blast furnace reline, a new metal coating line in Australia. We made an acquisition in the US just before the close of the financial year for a coating business, and of course, the money that we spent on the expansion at our North Star facility, our mini mill in North America. So we think carefully about that profile of projects that we have internally. There's money that's required to be spent for us to continue to decarbonise our business and meet the ever-increasing targets around greenhouse gas emissions. And then we also think about the cash that we generate in terms of returns to shareholders, and our board have enough confidence in the business model and the outlook that we've announced a 25-cent final dividend and also an up to $500 million buyback. So we're very mindful of what's happening in the market, our internal opportunities, but also returns to shareholders.
Mark, I know you don't have really a big sort of exposure to the Chinese economy as a general sort of rule, but certainly what happens there affects certainly the industry. Based on what we're seeing there as far as the weakness in the economy, where do you think that puts the outlook for the entire industry?
China has a significant impact in terms of the Asian markets in particular, so we watch that very closely. I think the signals that have come out of China in the last few years around their challenge to meet decarbonisation, reducing the amount of exports rather than bringing in high-cost imports and then selling product as low-cost exports, I think that's been fundamentally and structurally good for the steel industry in the Asian region. So we watch that data quite closely.
You mentioned a lot about sustainable steel making too, Mark, and I wondered, do you accept that when it comes to in the long term that hydrogen will basically replace coking coal eventually in the steel making process, and how long is that transition going to take?
This is an enormous challenge for the steel industry. This is not just a BlueScope problem by any stretch of the imagination. This is a global steel industry problem. There's not technology that's currently technically or commercially viable that sees us in a position where we can decarbonise. We're incredibly optimistic about the opportunities that hydrogen provides, but I'm also mindful, and I don't want to sound like a naysayer, I'm also mindful that there is just some time and a massive amount of investment that's going to be required to get us to a position where we have an ecosystem around hydrogen, we have enough renewable energy, we have the raw materials that are required for us to decarbonise our industry. We're a hard-to-abate industry. There's not a technical solution that's available at this stage, but we're all working very hard on it, and at BlueScope we've made a significant commitment, both in terms of people, resources and capital, to head down that decarbonisation path. My view is I think we're at least 10 years away from the hydrogen ecosystem being in a position where it can have a material impact on the steel industry.
Mark, just one of the other things too that's been hounding the industry, not just yours, pretty much virtually every industry out there, is just these supply constraints. I wouldn't say supply chain, supply constraints, you know, the energy squeeze in Europe. As far as inflationary pressures to your business, what are you seeing and what do you think persists?
There's no doubt there's some inflationary pressures. We're seeing that in labour across our footprint. We're seeing it in some consumables. We're seeing it in freight. Our businesses have been heavily disrupted over the last 12 months with isolation restrictions around employees not coming to work, our customers' restrictions around their people being in isolation. So there's no doubt we've seen an impact in our business from an inflationary perspective over the last 12 months. The supply chains have remained very tight. That's manifested itself in better pricing. So some of that inflationary impact has been offset by our ability to pass that through in price increases.